Hello there, this is Bruce at Fleet Capital Management. It's Friday afternoon, the 22nd day of November, 2024. Markets are closed. We're going to take a quick look at the markets. I'm going to continue our series of showing you a couple things, a very quick one this time, in our technical analysis series, if you will, to help you understand charts. So let's just jump right in. We always have to say the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell a security. I'm always available, as you know, Bruce at Fleet Capital Management. Excuse me. So this week we're going to examine something called divergence, which is a very powerful indicator, and how this information can help us. Before we do that, the single most important thing to know is whether the market's going up or down. Everything else follows from there. So let's take a look at our matrix. This is updated through today. Not much has really changed. We're a little bit mixed in this. OBV, remember, is on balance volume, and MACD is moving average convergence divergence. Now, remember I told you that two really powerful indicators that can be leading indicators to give you a sense of what's going to happen is volume, and that's OBV. We've looked at that. And momentum, that's MACD. Those two are mixed. I'll show you that on the chart. It doesn't mean a whole lot. It just says I need to keep my eyes peeled. On the weekly, both are in the green, and so everything's good there. Our moving averages are stacked perfectly, so they are bullish. Our weekly bear market avoidance indicator, the 10-week, is above the 20-week, so that's no problem. And actually, the VIX has come down a little bit more, which can be a pretty good sign that there is less fear and more strength going forward in the market, but we'll take a look at that. Let's take a look at the S&P 500. A couple things. Here's our moving averages. The 3 is over the 20, which is over the 50, which is over the 200. That's what I showed you there. Here is our volume. I would suggest that volume is the most important indicator. Our volume is in the green and growing, which is a good sign. There is growing buy-side volume. On the momentum indicator, which is secondary, in my opinion, to volume, we saw some weakness, and I described this either last week or the week before as the gas pedal. This is the gas in your car. If you don't have gas in your car, you're not going forward. And then you have to push down on your accelerator, and that is what makes things go up very quickly. And if you take your foot off the accelerator, your motion going forward is going to slow. And if it goes into the red, it just means you don't have a lot of upside momentum. But that's going to be true almost any time markets fall. You're going to be losing momentum. So this is just a way to see how's the momentum playing out. But volume, again, I'm going to say, at the risk of being redundant, in my opinion, is the single most important indicator. If we and so these are mixed. That was green and that was red, but getting better. So that's why it showed mixed on the graphic prior. This is the weekly, which means every bar is 1 week. That white line is the 2-week moving average that I just use for trading. And then the blue line is the 10-week. And this rust-colored line is the 20-week. That combination is our bear market avoidance indicator. And everything looks good there. Plus, the volume and the MACD are both positive. So as far as I'm concerned, we've had a little bit of chop and weakness. This week. We had a little bit of weakness, and then it started to roll back up. A couple of weeks ago, we had some pretty significant weakness, and then it really jumped back up. You can see in one of our lessons, we were talking about support and resistance, and I said that the 50-day moving average many times will act as an area of support, and that's exactly what happened there. Okay, so my point is everything looked good to me. I want to mention one stock that is in most portfolios. That stock is MCOR or EME. It was doing extremely well, had a little bit of softness, which is normal, and then it jumped back up. But today, it was down over 4%. Why? Well, we look down here at the news, and Goldman Sachs initiated coverage on this stock with a sell rating. Okay, every analyst has a right to do whatever they want. I am not a huge fan of Wall Street analysts when it comes to buy or sell ratings. I am a fan of Wall Street analysts when it comes to earnings estimates. They're very good at that. They're not very good at buy and sell. But this stock is a bit overextended. I mean, the angle that this linear regression is on is really good. It's almost too good, and it ran up to the top. It ran up to the top here. And what did I say? I said, if it breaks the linear regression to the upside or the downside, that suggests a possibility of it reverting back to the mean. This is a mean reversion. The red line is the mean going back 100 trading days. The blue line is 2 standard deviations above. The blue line down here is 2 standard deviations below. We had broken above and it came back down. That is to be expected. It went back up, but it wasn't really above. But then Goldman Sachs issued that sell rating and the stock dropped. It didn't close at the low of the day, but it did close in the lower third of the day, which is not something I like to see. I have raised our adjusted stop very strategically. If you see these little red dashes right there and the little green dashes right there, that's called a consolidation zone. It went as high as that, it went as low as that, it went up, it went down, it didn't break it, it went up, it did break it just a little bit. So I have put our stop. I'm normally not this tight, but because of that sell rating, because of the amount that this has fallen today, I have our stop pretty tight. Now, this is a great company. When I look at all of the fundamentals of this company, I'm extremely happy with it. There's nothing wrong with this stock. But if we get stopped out, we'll certainly get stopped out with a profit, a decent profit, and we will wait for a re-entry point, most probably, and probably go back into the stock. But I just wanted to show you what was happening today. It was down 4.18%. I've got a really tight stop. If we get out, we get out, and we'll look to go back in. Does that make sense? Okay, divergence. Let's talk about divergence for a second. If you have stock prices rising and momentum falling, those two things are said to be diverging. Prices going up, momentum is going down, or prices going up, volume is going down. Those are probably the two key areas that I look for divergence. I'm going to switch over to a different chart. It doesn't matter what the security is, but it's going to be, I think, easier to see a divergence. So let me scroll back here and let me look for a good example of divergence so that you can understand this. Well, here's one right here. So the price was going down. I'm going to put my crosshairs on so you can see this a little bit easier. From about here, and then the price is lower here. But if I look at, now this is an RSI, consider it similar to a MACD. You see that white line? So from this low right here to this low right here, same time frame, was actually rising. And that suggests to me that buyers are starting to kick in. Momentum was kicking in, even though the price was going down. And look at what followed. Bam. A big rise to the upside. Let's see if I've got another one. Okay, here's one. You can see that price is definitely falling here. And my momentum, both my volume and my momentum were rising. Price is falling. These two leading indicators were rising. And you can see right at the end of that, price shot up. It did pull back a little bit and then went significantly higher. So does this happen like that every single time? No, I wish it did. It would make life very easy, but it happens a lot. And when I'm teaching people about investments, and I have a number of folks that have asked me to teach them about investments, I tell them that you use these indicators so that you can anticipate, not predict, very different. You can anticipate what may come, and then you're looking for a reaction. How does it react? when it gets there. Here's an example. I'm going to show you another example. Here's a momentum rising as price was falling. There's a new low, and it went up just a little bit. So I guess it worked, but then it fell down. So none of these things are perfect. None of these indicators are perfect. They just aren't. Like I said, I wish they were, but they aren't. And we use them to anticipate maybe what is to come. So that's what divergence is. The key to that point is, and I'll go back to the S&P 500. The key to that is volume is the most important indicator, in my opinion. Momentum is second. And those two indicators are the only two indicators I've ever seen that sometimes can anticipate or predict, if you will, a market direction, what's about to come, because that's important to know since we live over here in this area where prices haven't happened yet. This was today. Next week is in here. So we need something to give us some idea of what may be happening. And that's what I use. So again, divergence is just what may be happening and what may be coming, and it's mostly on volume and on momentum. So not sure I did such a great job explaining that one. I hope I did. If you have any questions about it or you want to dig any deeper into any of this stuff, just shoot me an email or hop on my Zoom calendar. But I use all of these different things, all of these different indicators to try to, well, number one, to give me a sense of the trend. This is obviously an uptrend. Look at the linear regression, the blue-red box. Look at the angle. We're definitely in an uptrend. How does that help? Well, when prices were really weak back in here and in here and in here, I wasn't as worried about that because we were in an uptrend, and we're in an uptrend until the trend changes. So that was number one. Number two, if the indicators, the moving averages are stacked, meaning the 3 is above the 20, above the 50, above the 200, that's very bullish. So I will anticipate that prices are going to move higher next week. They may not, but that's what I would anticipate because of what I'm seeing here. We also have some growing volume. That gives me even more of a support to my feeling that prices may be rising next week. Momentum, even though it's below the zero line, it is coming back up, meaning downside momentum is weakening and it's moving towards upside momentum. That gives me a positive feeling going forward. When I look at the weekly and I look at all of those indicators, they're all in a bullish mode as well. So with all of that said, I would not hesitate to buy new stocks. So if we get stopped out of MCOR, especially if we get stopped out of that on Monday or Tuesday, and I don't know if we will or not, but if we do, I wouldn't hesitate to add new stocks to a portfolio because the technical indication and the seasonal indication, which we'll talk about another time, are both very positive as we run towards the end of the year. So that's how I use indicators. And I think I've kind of covered everything. We've got support and resistance, and there's all kinds, but all they're there for is to give us an idea, where are you in the game? I love sports, love football. Hope you saw Thursday Night Football last night. That was a great one in a blizzard in Ohio. But they need to know what yard line they're on. They need to know where they are in the game. Where's the clock? How much time is left? Who's driving the ball? Who's not? That's what these indicators, they kind of give us a sense of that. And like I said, they're not perfect. If you just think of the word indication, it gives us an indication of what's happening. It doesn't give us an absolute. So I hope that helps when you look at the chart. The other thing we went over real quick is I showed you whenever I enter a stock, here's my entry line. It's always white. And where it intersects with that vertical line, that's the exact day that I bought. This is EXLS that I bought this for you. That was a pretty good one right there. And we wrote it up, and then we had this pullback. You see that? Was I real worried about that? No, we're in a pretty solid uptrend. So I wasn't real, and we were coming into earnings. So many times people are getting out of a stock before earnings. And then we had a nice earnings, and then the stock exploded again, and we've already talked about that. So we have the entry point, we have our initial stop, and then every single day after the market closes, I look at my adjusted stops to see if I should raise those higher to protect our profits. And this is raised pretty high. You can see that I'm just below what's called a swing low, that red candle right there. It's almost like a V. I went just below that. That's a very strategic spot to put a stop. And we'll ride this up as high as it can. The green line that says 20%, that is nothing other than a visual for me. So I can just look at the chart and know how are we doing relative to 20%? And we're already over 20%. One of my initial goals is to get our adjusted stop above that 20% so that no matter what happens, we've made 20% on our money. So that's what's on the chart. That's everything. And I don't change it around much. But again, if you would like to understand this further, if you would like to dig as deep as you want, just let me know. I'm happy to do that. Other than that, have a fantastic weekend. You're probably preparing for Thanksgiving next week. If you heard any hammering in the background, that's my wife dolling up our house for Christmas. She loves to make it like a little Christmas cottage, and she does an amazing job. So that's what she's doing. And we'll be back together early Monday morning. Okay, I will talk to you then. Bye-bye.